Silver just exposed a truth gold has been hiding in plain sight, and the loudest people on the timeline are working overtime to explain it away as just another risk-on spike. The spot price is the headline, sure, but the real confession is happening in the plumbing, the near-term structure, the cost to carry, and the behavior of traders who don't get to have an opinion. And if you catch that mechanism now, you'll know exactly what to watch over the next 1 to 2 weeks, which levels actually matter, and what breaks this whole story if the market rolls over. Here is the cleanest way to frame what's happening right now. Gold is moving like a heavyweight at all-time highs, and silver is moving like a market that's running out of patience. In mid-January 2026, gold printed fresh records around the mid-4,600s per ounce, and silver didn't just keep up, it accelerated, breaking above $90 and even tagging into the low 90s before a sharp pullback. That matters, not because higher is higher, but because silver didn't do it quietly. It did it in a way that forces everyone involved, hedgers, shorts, dealers, and index flows, to make decisions on a calendar. And that's where the real pressure starts. Zoom out just one step, and the outperformance is obvious even if you refuse to look at charts. In January alone, silver has been up on the order of a couple dozen percent, while gold is up a single-digit percentage. That's not a moral victory. That's a signal about sensitivity and structure. Silver doesn't need a perfect world to run. It needs tightness at the margin, thin liquidity, and enough stress in the system that paper comfort starts to fade. And right now, you can see all three. Now, before anyone tries to turn this into a simplistic story, silver is industrial, gold is monetary, end of discussion, I want you to hold one thought. Silver is both. That's the entire game. Gold is a pure macro mirror. Silver is a macro mirror that also plugs directly into procurement, manufacturing, and supply chains with lead times. So when the world gets jumpy and the real economy still needs metal, silver becomes this weird hybrid, half safe haven, half input cost, and fully volatile. It's like you strapped a turbo to a reserve asset, and that turbo is exactly why it outperforms during certain phases. But that's not the part that matters. The part that matters is how Silver-S outperformance shows up first, where most people never look. Not in the spot quote, but in the urgency of the front end. In plain English, markets don't just trade a price, they trade a timeline. They trade how badly do you want it now versus later. And when the now price starts acting different from the later price, that's the market admitting something about availability, financing, and stress. That's your hidden detail. And once you see it, you can't unsee it. Let me make this painfully simple without dumbing it down. In a normal, calm commodity market, future delivery typically costs a bit more than right now delivery because you're paying for time, storage, insurance, financing. That's contango. It's boring. It's the market saying, yeah, we can get you metal, no drama. But when the front month starts getting bid up relative to later months, when the curve flattens or even flips, you are looking at backwardation. That's the market saying, I will pay you to give it to me sooner. And that's not an emotion, that's math. Because if this one relationship flips, the incentives of every participant flip with it. And in silver, those incentives snap fast. Why? Because the liquidity is thinner, the volatility is higher, and the deliverable concept is more fragile than people want to admit. Not because there's a cartoon villain pushing a button, but because a lot of the inventory people quote isn't necessarily ready, willing, and available to settle the exact contract that's under pressure. And that distinction becomes everything when demand stops being polite. Here's the next layer, and it's the one that makes this move feel like it changes everything. Silver isn't just rising, silver is getting more expensive to trade. That sounds like trivia. It isn't. When an exchange hikes margin requirements repeatedly during a rally, it's basically telling you volatility is exploding, and we're forcing participants to post more collateral to play. That's risk management, not a conspiracy, but the consequence is brutal and mechanical. It pressures leveraged positions, especially shorts, exactly when price is moving against them. And that's where the reflexivity begins. Think about what a short position is in real life. It's not a meme. It's a promise backed by collateral. When price rises, your loss grows and your collateral requirement can rise at the same time. That double squeeze is why silver rallies don't look like gold rallies. Gold drifts higher and pulls capital in. Silver sprints, forces balance sheets to react, and then shakes everyone by the ankles on the retrace. And the next detail is what flips the whole setup. Those margin dynamics can create forced buying even if nobody wants more to buy. Now layer in the calendar. January is not just a page flip. It's a positioning reset. Funds rebalance. Commodity indices rebalance. Risk budgets get reloaded and sometimes they get tightened. Liquidity can be thinner than it looks because everyone is still adjusting to new exposures. And when you combine a fast-moving metal with a forced calendar event, you don't get a smooth trend. You get bursts. You get gap risk. You get, why is it moving like that? Moments. And if you treat those moments as random, You become the liquidity for someone who understands the timetable. One of the biggest why now forces in early January 2026 has been index rebalancing pressure hitting metals at the same time the market is already stretched. When major commodity indices rebalance, the funds that track them don't get to debate it. They execute. That can mean chunky, time-windowed selling, billions in gold and silver over a narrow range of days. And here's the punchline. When a market absorbs forced selling and still holds key levels, that's not weakness. That's demand showing itself. But that's not the part that matters. The part that matters is what happens after forced flows finish. Because if you had a built-in seller for a week and the price action refuses to collapse, then when that seller disappears, the market can breathe. And breathing in a tight market looks like a jump. It looks like silver ripping to new highs, pulling the gold-silver ratio down, and forcing the skeptics to chase at worse prices. And then the headlines will pretend it was just geopolitics. Sure, geopolitics is a spark, but structure is the gasoline. Let's talk about the geopolitics piece quickly, because it's real and it's in the tape. In mid-January 2026, precious metals have been reacting to elevated global tensions and political uncertainty, including fears tied to conflict risk and questions around central bank independence. That kind of atmosphere lifts gold first. Gold is the default refuge. But when gold lifts hard and stays elevated, silver starts to catch a second wave, because silver is cheaper per ounce, easier for retail to engage with psychologically, and more sensitive to risk premium moments. That's the behavioral layer. But if it was only behavioral, silver would fade as quickly as it spikes. The fact it has powered higher through heavy flow windows tells you something deeper is going on. Now here's where retail investors usually get tricked. They look at silver and think, it's just gold, but more volatile. That's like saying a sports car is just a sedan, but faster. Technically, both have wheels. Practically, one behaves totally differently when the road gets wet. Silver's dual demand means it doesn't just respond to fear and rates. It responds to procurement, industrial cycles, and supply friction. And those forces don't turn on a dime. Start with industrial demand, because it's the layer that makes silver's outperformance more than a trade. Solar expansion, electrification, power grids, electronics, data infrastructure, these aren't Instagram trends. They're CapEx cycles with contracts, lead times, and purchasing managers who get punished for being wrong. If you're a manufacturer and you need silver for production, you don't get to say, I'll wait for a dip. Sometimes you hedge, sometimes you lock in, sometimes you buy the metal. And when those buyers show up at the same time investors are buying, price discovery gets spicy. That's where the real pressure starts. And now flip to supply. The popular myth is high prices bring more supply. Sometimes. But silver is often a byproduct of mining other metals like lead, zinc, and copper. That means silver supply is partially hostage to decisions that are not primarily about silver. If a miner's economics are driven by a different metal, silver doesn't magically surge in output just because silver price rallies for a few months. Add refining constraints and logistics, and you've got a supply response that moves like a barge, not a jet ski. Demand can spike this month, supply cannot. Recycling helps at the margin, but recycling is also not instantaneous. It's collection, processing, refining, and distribution. In a world where industrial demand is structurally higher and financial demand is opportunistic, the margin can get tight quickly. And tight at the margin is all a thin market needs to move violently, because the price is set on the margin. It's not set by the comfortable middle. Now let's pull this back into the market structure again, because that's the finance literate core of this whole episode. Futures markets exist to let producers and consumers hedge, but they also attract speculators, dealers, and funds. That's normal. The key is that not everyone is playing the same game. Some are managing inventory, some are managing risk, some are managing exposure to volatility. And when silver starts moving, it forces these groups into predictable behavior. Here's a simple version of that behavior. If price rises fast, volatility rises. If volatility rises, margin requirements rise. If margin requirements rise, leverage participants reduce exposure. If shorts reduce exposure, they buy to cover. That buying pushes price higher, which lifts volatility further, which reinforces the cycle. That is reflexivity. It's not a fairy tale, it's a feedback loop. And in a metal like silver, it can turn a strong move into a nasty squeeze faster than people expect. You can see the market acknowledging this volatility directly. Implied volatility measures on silver have been elevated. When the market price is in big swings, it's telling you the risk isn't just direction, it's amplitude. That's your warning label. And if you ignore that label, silver will humble you in public. Now let's address the phrase that always lights people up. Paper versus physical. Most people use it like a slogan. I want you to use it like a mechanism. In the futures world, a lot of contracts are closed out or rolled. Very few go to delivery. That's fine. But the option to deliver is the anchor that keeps futures from becoming pure imagination. So what happens when the market starts caring a little more about that anchor? What happens when the front end tightens, when the cost to trade rises, and when physical friction starts showing up in the street? You get symptoms, not proof of a grand plot. Symptoms of stress, retail premiums creeping, delivery times stretching, mints getting backlogged, and institutional products seeing renewed interest. You don't have to worship any one symptom. You stack them. Mechanism, then behavior, then friction. And when they align, you respect it. But that's not the part that matters. The part that matters is how arbitrage responds. If one pocket of the market is paying up for immediate metal and another pocket is trying to price it calmly, the difference becomes an opportunity. Arbitrage is not optional. It's a vacuum cleaner. Metal flows toward the highest urgency, and paper positions adjust to avoid being the weak link. That is why these episodes can feel like the market suddenly snaps to a new level. It's the system equalizing stress. Now, let's make this practical. If silver is outperforming gold right now, the scoreboard most people use is the gold-silver ratio. When the ratio drops, silver is outperforming. When it rises, gold is outperforming. In early January 2026, that ratio has been hovering around the high 50s to around 60, depending on the exact prints, which is meaningfully tighter than the looser ratios people got used to in prior years. Translation. Silver has been acting strong relative to gold, and when that ratio compresses during a metals rally, it is often a sign that the move has moved from safe haven bid to pot momentum plus tightness plus optionality. That's when it gets dangerous in both directions. Because yes, silver can absolutely faceplant even if the bigger thesis is correct. I need you to tattoo that into your decision making. Silver will whip around violently. It will do it on days when nothing happened. It will do it because liquidity thins, because margins change, because a big fund rebalances, because someone gets a risk call at 3 p.m., because dealers hedge options into a close. If you only have a narrative, you'll get shaken out. You need a process. And the next detail is what flips the whole setup. The difference between trend signals and noise. Trend signals are structural. They persist across multiple sessions. They show up in the curve, in spreads, in the ability to hold key levels after forced selling, and in the way dips get bought without needing a fresh headline. Noise is emotional. It's a one-day spike, a one-day dump, a wick that terrifies you, a tweet that makes you feel late. If you trade noise in silver, you will become the punchline. So you build a two-scenario lens, and you stop pretending you can predict every candle. Here's that two-scenario lens, clean and usable. Scenario 1 is the controlled pullback and retest. Silver backs off from the highs, maybe because profit-taking hits after a vertical run, maybe because index flows or margin changes, force temporary de-risking. Price drops into prior breakout territory. Think the mid-80s to high 80s zone based on recent prints, and it stabilizes. The curve calms a bit. Volatility stops accelerating. Dips start getting bought, not in a manic way, but in a someone needs exposure way. If that happens, it's actually constructive. It turns a vertical move into a tradable structure. And that's where the real pressure starts, because the market builds a base to launch from. Scenario 2 is the continuation squeeze. Silver doesn't give you a polite retest. It holds above a key pivot, around 90, and starts climbing again, pushing into the low 90s and threatening the psychological $100 level. In this scenario, volatility remains elevated, spreads stay tight, and any dip becomes a trapdoor for shorts who thought they'd get a better entry to cover. You'll see faster moves, bigger gaps, and more. How is this happening? Moments. This is the scenario that makes people wealthy and wrecked in the same month, depending on their sizing and their discipline. Neither scenario guarantees anything. This is not about calling tops. It's about recognizing what the market is forcing participants to do. And if you want a near-term roadmap, you anchor it to a handful of levels and tells. Let's start with silver levels, because this is where the audience always wants something concrete. The first level is psychological. $90. It's not magic, it's just a magnet. When silver first breaks above a major round number, that number often becomes a battlefield on the pullback. If silver holds above $90 on a closing basis after dips, the market is telling you the breakout is being defended. If silver loses $90 and can't reclaim it quickly, that's a sign the move might need more digestion. But that's not the part that matters. The second level is the breakout shelf beneath it, roughly the mid-80s to high 80s zone, where silver traded before the most recent surge. We've seen prints around the mid-80s in the days leading up to the push, then the acceleration into the 90s. Markets love to revisit those shelves. If silver comes back toward that zone and buyers step in with patience, that's confirmation of real demand. If silver slices through it like it isn't there, that's your thesis is weakening signal. Not because the long-term story dies, but because the near-term structure breaks. The third level is the obvious one, $100. People roll their eyes at round numbers until round numbers start forcing behavior. A move toward $100 pulls in momentum funds, triggers psychological FOMO, and increases the risk of policy-like responses from risk managers, more margin adjustments, more volatility hedging, more de-risking. A clean break above $100 with follow-through would be a regime moment for silver sentiment. A failed tag that rejects violently would be the classic silver taught them a lesson candle. And that's where the real pressure starts. Now layer in gold, because gold is the anchor. Gold has been hovering around record territory in the mid-4600s, with recent peaks near 4,140. If gold stays firm and silver outperforms, that's a supportive macro backdrop. If gold rolls over hard while silver is stretched, silver can get dragged down brutally because it's the higher beta. So one invalidation watch is simple. If gold loses its footing and the whole metals complex de-risks, silver won't be immune. Silver's outperformance is a feature, but it's also a vulnerability. Now the ratio. If gold, silver keeps compressing, or stays in the high 50s or pushes lower, that's silver leading. If it suddenly reverses higher while silver is struggling at $90 and gold is stable, that's a warning that silver's leadership is fading. The ratio is the lie detector for relative strength. It's not perfect, but it's fast. Okay, but what do you watch this week and next week that actually tells you whether the hidden detail is still active? You watch the parts of the market that are hardest to fake. One, you watch the front end behavior. You don't need to be a derivatives quant. You just need to pay attention to whether near-term tightness vibes persist. If the market keeps paying up for immediacy, always, if the front month stays special, that's supportive. If the curve relaxes sharply, that suggests stress is easing. Easing stress doesn't mean price must fall, but it removes a key accelerant. Two, you watch volatility and trading costs. Elevated implied volatility is a fact of life in silver. But if it spikes further while price climbs, it increases the chance of forced behavior. If margins rise again, expect fireworks. Not because it's bad, because it forces position resizing. Forced resizing is why silver moves in cliffs. And that's not the part that matters. The part that matters is how price reacts after those forced events. If silver absorbs higher trading costs and holds levels anyway, that's strength. If silver melts down the moment conditions tighten, that tells you the move was too dependent on leverage. 3, you watch big flow windows. Index rebalancing pressure is a perfect example. When forced flows hit and silver refuses to break, that's a tell. If another forced flow event appears, month end, quarter end, systematic fund adjustments, you don't guess. You watch whether the market holds the shelf or gives it up. 4, you watch real world friction, not as gospel, but as confirmation. If demand is truly hot, you often see signals like product tightness, premiums, delivery timelines, and increased interest in physically backed vehicles. Again, not proof of anything dramatic, just the market's on-the-ground symptom that complements the curve and the price action. Proof stacking matters because any single indicator can lie. 5 indicators aligned rarely lie. 5, you watch positioning behavior indirectly. You can't see every book, but you can see the footprints. Sudden intraday squeezes, relentless dip buying, the inability to sustain breakdowns, and those late-day ramps that scream risk management. When a market keeps moving in ways that punish the obvious trade, that's usually because the obvious trade is overcrowded, and silver loves punishing crowds. Now we need to talk about the psychological trap, because if you're watching this, you're likely one of the few people trying to do it with logic instead of vibes. Silver will try to manipulate you emotionally, and it doesn't need intent to do it. Volatility itself is the manipulation. Here's how it happens. It gives you a clean breakout. You hesitate. Then it rips 6% in a day and makes you feel stupid. You chase, then it drops 8% in an afternoon and makes you feel reckless. You panic. Then it recovers and makes you feel cursed. That cycle is how most people lose money even when they were directionally right. The defense is not predicting. The defense is sizing, planning, and separating trend from noise. So build rules. Not 10 rules. 2 rules you can actually follow. Rule 1, decide in advance what price action would make you admit you're wrong and honor it. Not because you lost, because you protected capital and clarity. In a move like this, the invalidation is not a 1-hour wick. It's a failure to reclaim key pivots after a breakdown. It's the market losing the breakout shelf and not snapping back. It's the ratio reversing against you while the anchor metal stays strong. That's information. Rule 2, don't let a single candle change your time horizon. If you're trading the next 2 weeks, trade the next 2 weeks. If you're positioned for a longer regime shift, don't let a lunchtime dump make you behave like a day trader. Silver punishes time horizon confusion more than it punishes wrong opinions. And that's where the real pressure starts. Now, I want to address the skepticism head on because the most valuable audience in metals is the skeptical audience. The skeptics ask, if silver is so tight, why can price drop 3% in a day? because futures markets can reprice risk faster than physical logistics can respond, because leverage can unwind in minutes, because margin changes, and fund flows can overwhelm near-term fundamentals temporarily. A market can be structurally tight and still dump when forced sellers appear. That's not a contradiction. That's the nature of a financialized commodity. And if you want the cleanest evidence-driven framing, silver is outperforming gold right now because silver is simultaneously being pulled by macro fear and pushed by industrial reality, while the trading structure is adding fuel through volatility margins and near-term urgency signals. That's 3 layers. Add forced calendar flows and you get a 4th. That's why this move feels different. It isn't one narrative, it's multiple systems converging. So what comes next? Like, practically, what should you expect over the next week or two? Expect violent swings even if the thesis is correct. Expect at least one move that feels like it breaks the rally, followed by either a snapback or a deeper digestion. Expect $90 to act like a hinge. Expect the mid-80s shelf to matter if we get a pullback. Expect $100 to become the story everyone fights over if silver holds above $90 and the broader metals complex stays firm. And most importantly, expect people to get emotionally baited into doing the wrong thing at exactly the wrong time. If we get scenario 1, the controlled pullback, watch for stabilization above that breakout shelf, watch for the ratio to hold its compression, and watch for the market to stop reacting negatively to margin and flow headlines. That would suggest the move is transitioning from squeeze energy into trend energy. If we get scenario 2, the continuation squeeze, watch for price holding above $90 and grinding higher without giving clean entries. Watch for volatility staying elevated, and watch for fast intraday recoveries after dips. That would suggest forced buying is still in control, and the market is trying to price in scarcity of immediacy. And that's where the real pressure starts. And now the final piece, the subtle one that actually makes you money over time. Your identity in the market. Don't be the person who needs to be right on the exact day. Be the person who tracks the tells, respects invalidation, and refuses to get whipped into panic decisions. If you can do that in silver, you can do it anywhere. So here I'm going to ask the quick checklist you keep in your head without overcomplicating it. Is silver holding the psychological pivot? Is the breakout shelf intact on pullbacks? Is gold staying firm as the anchor? Is the ratio confirming silver leadership? Are near-term stress signals easing constructively or snapping tighter again? If those answers stay supportive, the move isn't just noise. If those answers flip, you don't argue with the tape, you adjust. And if you're the kind of investor who prefers mechanisms over slogans, who would rather watch spreads, flows, and forced behavior than chase headlines, then you're already in the right room. Stick with that mindset. Share your level checks, not your predictions. We don't need louder opinions. We need better process.